All right, today we're opening up the case file on one of the most important businesses in tech, Amazon Web Services. We're going to unpack the real story behind its recent growth slowdown, a story that, frankly, goes a lot deeper than the headline numbers. So let's just get right into it. On the surface, AWS is still the undisputed king of the cloud. It's an absolute behemoth. But when you look at the data, you see this massive contradiction. It raises the core question for our investigation today. Why is the cloud king lagging its rivals in the growth race? You know, the official narrative from Amazon always praises its massive multi-billion-dollar revenue every quarter. And that's fair. But the data for Q2 2025, it paints a totally different picture of the momentum. AWS grew at just 17.5% year over year. Now, in that same period, Google Cloud, 32%, and Microsoft Azure, a staggering 39% growth. This isn't just a small gap, people. It's a performance chasm, and that demands a real explanation. To really understand this, we have to push past the corporate press releases. You have to dig into two key factors that are actually deeply intertwined. Our investigation shows this is a story of, first, a very real physical capacity crunch, and second, a newly effective and really aggressive competitive landscape that's taking full advantage of it. So let's follow that first lead. The capacity crunch. The big question here is whether AWS has become a victim of its own incredible success. Our analysis points to the primary bottleneck not being a lack of demand, but a physical inability to meet that demand. The story really starts with what I'm calling the AI demand shock. The market's pivot to generative AI wasn't a gradual shift. It was an abrupt, seismic event. All of a sudden, everyone needed incredibly power-hungry, GPU-accelerated computing. This just completely upended the old models for planning data center capacity. I mean, we're talking about a segment that AWS itself says is already a multi-billion-dollar business, and it's growing at triple-digit rates. The demand just exploded. So what's the response? A complete tidal wave of spending. Amazon is on track to pour over $100 billion into capital expenditures in 2025 alone. And their leadership has been very clear. The vast majority of that insane amount of money is being funneled directly into building out AWS AI capacity. But here's the critical point for an analyst. My view is that this isn't just proactive investment for what's coming next. It points to a much deeper issue. This is reactive catch-up spending. It's a less efficient, way more expensive scramble to cope with overwhelming demand that's already hammering on the door. And this kind of disconnect, where spending skyrockets before revenue can catch up, is a classic sign of a supply-side bottleneck. And you can bet it's already squeezing their margins. And look, this isn't a simple fix. It's a three-layer bottleneck. Layer 1, semiconductors. There's just not enough global capacity for the advanced packaging needed to make these high-performance GPUs. Layer 2, and this is probably the biggest long-term headache, is power. The electrical grids in key hubs like Northern Virginia are just saturated. They're full. We're talking multi-year delays just to get a new hookup. And Layer 3 is just basic logistics. The lead times for stuff you absolutely need, like generators and switchgear, have ballooned to 70, 80, sometimes over 100 weeks. You literally can't turn on a data center without them. And hey, you don't have to take my word for it. In the Q2 2025 earnings call, the CEO of Amazon, Andy Jassy, said it flat out. We have more demand than we have capacity. The single biggest constraint is power. It's about as clear an admission as you can get that supply, not demand, is what's holding back growth right now. So the conclusion from this part of our investigation is pretty unavoidable. AWS is leaving a ton of money on the table. We're even hearing reports of so-called zombie data centers. These are facilities where the expensive server racks are all installed, but they're just sitting there, dark, because there is no power to turn them on yet. They simply can't onboard customer demand fast enough, and that directly puts the brakes on revenue growth.
Now, this capacity crunch, it doesn't happen in a vacuum, right? It created a huge strategic opening. And while AWS has been physically constrained, its competitors, well, they've seized the moment. Let's dig into how they've done it.
The difference in strategy is just crystal clear when you compare their AI offerings. On one side, you've got AWS with Amazon Bedrock. Their play is to be a neutral model marketplace, offering customers a choice from a bunch of partners like Anthropic and Meta. Then you look at Microsoft Azure. They made a deep, early, and very exclusive bet on OpenAI, And that created this powerful enterprise flywheel, tying the most recognized AI models in the world directly to their cloud.
And Microsoft's execution on this strategy has been nothing short of masterful. They got a massive first-mover advantage with OpenAI. They're bundling Azure AI services right into their existing enterprise agreements, making it a totally frictionless choice for big companies. They're using their consumption commitment contracts, MCC, to lock customers into large multi-year AI deals. And the result? Over 53,000 Azure AI customers have been pulled in by this tightly integrated approach. It's a textbook case of leveraging their existing enterprise dominance.
But at the same time, you cannot ignore the third player here. Google Cloud is leveraging its incredibly deep history in AI research. I mean, these are the people who invented some of the foundational tech to emerge as a really credible AI-native competitor. They aren't just a follower anymore. They are carving out their own very strong strategic position.
And where you really see Google's success is with the next generation of companies. Their own data shows that a huge chunk, over 60%, of all the funded generative AI startups are choosing to build on Google Cloud. So while Azure might be winning the big enterprise deals today, this strongly suggests GCP is winning over the AI innovators of tomorrow.
So here's the bottom line. This competitive threat is not some temporary blip. While AWS has been wrestling with its physical constraints, both Azure and GCP have developed and executed incredibly effective strategies to snatch market share. This is a fundamental shift in the cloud landscape.
Okay, let's pull all these threads together. It's time to synthesize all the evidence and deliver the final analyst's take from this investigation.
Our investigation has clearly identified two main interconnected reasons for AWS's growth slowdown. First, a severe AI-driven capacity shortage. That's that multi-layered bottleneck of chips, power, and logistics. And second, a newly effective competitive landscape, where you have Azure outmaneuvering AWS in the enterprise and GCP building a really strong foundation with the next generation of AI startups. All of this leads us to one final, critical question, both for investors and for the industry. Is AWS just playing catch-up on capacity, a problem that its massive spending will eventually solve? Or is it actually falling behind strategically in a market that has fundamentally changed around them? The race is definitely on, and for the first time in a very, very long time, AWS is not the one setting the pace. Thanks for joining this explainer.